As Marty just said, my name is Andy Connor. I'm the Chief Investment Officer here at Asset Strategy Consultants. We're hosting this conference here on site. I do think it says a lot about the last 18 months and my mental health that I was more comfortable retreating up to my office to do this presentation rather than standing down there with Marty in front of the laptop and the screen. I just had much more level of comfort sitting in front of my own laptop. I think that's an interesting commentary. So Asset Strategy Consultants, Al mentioned earlier, is a Baltimore area investment advisory firm. We've been around for 30 years and we manage about $8 billion of client assets, both institutions and families. My main mission in life is, as CIO, is to be a senior member of the investment team, but also to oversee what I call our outsourced investment office, which is our OCIO or outsourced CIO platform. And in doing that, we employ what is called the endowment model of investing, which has really three key components. The first being thinking long-term and building equity-oriented portfolios for long-term growth. The second is diversification, so using a very diversified mix of equity and equity-like things, so you're not loaded up and you don't get hurt quite as badly when the markets go down. And then third is active management, and in particular, utilizing alternative investments. So I, as Al Morrison, one of our founding partners, mentioned earlier this morning, I joined the firm from Johns Hopkins University, where I was a member of the Office of Investments there for 12 years. And we managed a roughly $5 billion endowment and another $2 billion of other university and hospital assets. A key point to make here is, as a firm, ASC, we are allocators. So we don't have products. We invest in funds, and we're at a vantage point where we look across markets and asset classes and industries for opportunities that our clients can take advantage of. This is a particularly difficult investment environment. I think everyone probably shares that sentiment. Interest rates are historically low. Valuations in the stock and bond markets are at historic highs. The economy seems to be doing well. There's some potential inflation out there, but it's not I mean, it never seems like it's easy, but this seems like a particularly difficult time to find assets that we would consider to be cheap. So today, the topic of conversation, private credit, is one area where we have seen some opportunity and some what we think are some pretty compelling openings for investors of the right mindset and the right ability and the right scale. So relative to private equity, which is a great part of a long-term portfolio for total return, in private credit, we're actually seeing more of an illiquidity premium relative to liquid credit than we are seeing in private equity relative to liquid equity. And I think that's a function of the bond market actually being more overvalued than the stock market at this time, with rates being so low. So the private credit covers a fair number of different things, and I will run through these quickly. I don't want to get too bogged down in any of the slides, but rather zero in on where we're seeing opportunities. But I think it'd be useful just to lay some groundwork here. So this table basically lays out private credit strategies from core to more opportunistic to very niche oriented. And the core, or most established, being direct lending and mezzanine. We are not generally big investors in mezzanine. We actually, because as I mentioned earlier, we try to build equity-oriented portfolios. I think the upside downside in mezzanine has not been compelling over a full cycle. There are absolutely entry points where it makes a lot of sense, but on a dedicated basis, probably not so much. But in direct lending, we are seeing tremendous opportunities, in particular in the lower middle market, where we're seeing an opportunity for double-digit returns. Being a senior lender. So the rest of these categories include structured credits, things like CLOs, which actually are somewhat interesting right now because credit spreads are so tight and you're issuing into those. Real asset lending, in particular, lending against things like real estate, that's a very competitive business. And when you have hard collateral like that, the returns have really been bid down, along with interest rates. Distressed and special situations and multi-sector, where you may rotate from structured credit into distress throughout the cycle, we do find very compelling as a long-term investment for a manager with an appropriate platform of span and scale, who can really allocate through the credit cycle. Certainly last March, we saw a very abrupt and abbreviated credit cycle where there were great opportunities that came and went. And then there are always opportunities in specialty finance, niche strategies. I looked earlier this year at a fund down in Texas that was, their strategy was credit card receivables that had been written off by banks. So they were actually structuring their investment in the form of a loan to a firm who would acquire, who was licensed to acquire those receivables and then basically work on collections. And essentially by buying these receivables at say 2 cents on the dollar and then recovering 4 to 5 or 8 cents per dollar, they can generate a very compelling return. But that's not a particularly scalable strategy, which is okay. I think, I don't think many great strategies are very scalable. So these strategies in general, the underlying is illiquid. And so the fund structure also is appropriately illiquid. Some time ago, I worked with Austin Long at a firm called Alignment Capital. Austin set up the UTIMCO, University of Texas, private equity program before leaving to start Alignment Capital. And he had an interesting saying. He would say, illiquidity isn't a risk, it's a certainty. So it's definitely, you just have to be comfortable with the illiquidity in order to invest in these strategies. Also, it's generally necessary to be a qualified purchaser, and some of the vehicles permit accredited investors. So something to keep in mind. This chart shows in risk return space the different strategies that we just referred to. So the higher along the y-axis, the higher the expected return of the strategy, and then the farther out to the right on the x-axis, the more risk. So distressed debt being the highest risk in return. I will also mention, it's not particularly captured here, but those also tend to be higher beta strategies, meaning they're more correlated to the equity markets. And so if the stock market goes down, you're going to get hurt by owning distressed debt most of the time. It's just they're not necessarily owning a lot of equity, but the credit within those strategies tends to behave like equity. On the other end of the spectrum, direct lending, in the middle of the chart here, the circle, the black circle, those tend to be less market sensitive. It's not that there isn't company level risk in the strategies, there absolutely is, but the underlying instrument tends to be held at cost as long as it's performing. And so they're very steady. They tend to pay interest monthly, and the fund may distribute it that frequently or quarterly. But as long as it's a performing instrument, they don't tend the marks don't tend to move too much, and so there is the potential for some diversification benefit there. I don't want to spend too much time on this slide because it has capital asset pricing model on it, other than to during this slide talk about some of the things we look for when we talk to a direct lending manager. So there are a lot of managers, and direct lending strategies are vary considerably from manager to manager. So usually when we meet with a manager, there's 4 or 5 questions I will ask just to get a sense for where they reside and what their strategy is. And the first is, what type of collateral are they lending against? It's one thing if it's real estate, it's another thing if it's a business with hard assets, or real estate, it's another if it's a growth business that may not own any tangible assets. Those are obviously different strategies, and the risks should be priced differently. The next question is where they lend in the capital structure, whether they're senior, first in line in the event of bankruptcy, or they might be junior, like mezzanine, behind some other debt instrument. or whether it's unitranche, meaning they lend across those, they basically take the entirety of the capital structure. And so those allow us to, again, kind of pinpoint the risk level, along with the size of the asset or the size of the loan. So you have very large transactions where it's a capital scale game, and they tend to be very competitive, and the rates of those loans get bid down substantially. And as you get smaller to the mid-market and then what we call the lower mid-market, it's much less efficient. There are fewer competitors, and even the opportunity to really just directly originate with a lender one-to-one rather than having, an investment banker or an intermediary really run a process where everyone's bidding. You may be the only loan on offer, in which case you can really set your pricing within limits, right? You can't price it to the point where they would be better off issuing equity, but you can, really control pricing more significantly at the lower end of the market. I also ask about the loan to value, the typical loan to value, or the debt to earnings. Just how much are they lending? How risky, would the loan be, and how much coverage would they have in the event of an adverse outcome, such as a bankruptcy or a liquidation. Another really key dimension is whether the transaction is sponsored or non-sponsored. And by that, we mean whether there's a private equity or real estate sponsor, meaning a fund or a professional real estate investor, who is putting together this transaction and then going out to look for the debt. Those tend to be fairly savvy and acquirers, and therefore they set up competitive processes for the debt that they're borrowing. And if it's a non-sponsored transaction, oftentimes you're dealing with the owner of the company, and so that's a very different dynamic, different objective function, and in our view, in many cases, preferable, although can be riskier because there's no sponsor to stand behind the transaction if things go bad, to put in additional equity necessarily. And the other really key dimension is whether the fund that we would invest in, who's going out and issuing these loans, whether that fund is levering their fund itself. So many of these strategies, particularly down here at the with harder collateral and lower coupons on the debt, will actually put leverage on their own fund. So the fund will borrow and they'll invest, say, 150% of capital into these loans in order to juice their return. In general, my preference is not that strategy. It's to have more company-specific risk and no leverage at the fund level. And the reason being is if you have 10, 12, 15, 20 companies in your portfolio or loans, those tend to diversify with one another, assuming they're not all in the same industry or that sort of thing. Whereas if you have leverage on the fund level, that really can cut you both ways in terms of magnifying positive and negative returns. Just to return to this slide, the one thing that I'll layer on top here is what we call alpha, or manager outperformance. And that is really a key part of this whole strategy, and why we ask those questions and really try to dig into the underlying strategy and understand them. So as I said earlier, we prefer the middle market, and in particular the lower middle market, when we invest in direct lending strategies. The underwriting is critical. So that's probably the next thing we really dig into in due diligence on these fund managers, is their level of underwriting, their experience doing that, the investment judgment that they show in dealing with choosing the loans that they go forward with, as well as how they work with lenders during the course of the relationship. We prefer that they be fairly conservative in terms of underwriting, although again, they may be investing with a company that has a high risk profile, that they're conservative on how they underwrite their instrument or their loan. Also, if they have direct experience writing the document, negotiating the deal, that is really important. We want them to understand, and we often ask them what are the key terms that they look for, what are some things they won't give up, one of the things that they're flexible on, just to understand how they underwrite, and again, their investment judgment. And another really important thing is whether the fund manager has any workout experience or any operating experience. So if you're going to lend to a company, you really have to be willing to take the keys to the company. You really need to be willing to foreclose, to take the asset, to manage the asset and work it out until a liquidation. Otherwise, the equity, which is beneath you, will call your bluff, and they can just, say, hey, well, fine, take the keys. And if you're not capable of doing that, then you have to basically give them what they want or give concessions. And so what we need is, what we prefer are people who have operating experience, workout experience, have been through those things, so that when the inevitable deal does go south, they can actually handle it and also be in at least a strong position vis-a-vis the equity that's underneath them. So I think I've spoken about most of what's on this page, as a matter of fact, already. The reason for this opportunity, or one reason, is banks have sort of vacated this space, certainly at the small end of the market. Groups like CIT and GE Capital just don't no longer exist, at least not in this space. And they were really the big mid-market lenders, say 10 to 15 years ago. The global financial crisis really decimated a lot of that. At the very small end, say a loan of $2 to $5 million, the SBA, Small Business Administration, is there, and those loans are generally fairly well available at the very small end. And again, at the large end, if you're talking 50 to 100 to $500 million plus loans, big private equity sponsored transactions, the big private equity deals, again, that's fairly competitive, big funds competing against one another, very standardized transactions where fees and terms are the key attributes that win the deal. We like the middle, where say it's a $10 to $50 million loan. The company is a growth company, but it may be asset light. They may not own hard assets, so it's difficult for a bank to get comfortable with that loan. But the company doesn't want to issue equity because they believe in their growth prospects, and so it's attractive to them to issue debt and to take a loan at, say, mid-teens, 12 to 15, 16%, because they're pricing their equity at much more valuable than that. And there are also some dislocations at that smaller price point where the private banks who otherwise would lend to those companies are not able to. So if an entrepreneur or a high net worth individual has liquid securities and a margin account at a private bank, they can easily borrow, take a margin loan or borrow against those. If a high net worth person owns a business and they are running the business and it's an illiquid business, but it may be worth 10, 20, $50 million, it's really difficult for the private banker to lend against that. They just don't have the mechanisms in place to underwrite it, to get comfortable with that risk, the way they do with liquid securities in a brokerage account. And so that's where we see a fair amount of opportunity stepping into those types of transactions. Finding fund managers who target those types of those opportunities. The mid-market is also just a very good hunting ground in terms of the amount of the economy that it comprises. There are a huge number of smaller companies and mid-sized companies. It explains a fair amount of GDP and jobs. And so there's just a lot of variety and a lot of different companies. Many of these companies that some of our fund managers lend against are newer companies. They may be around for a few years, and they're growing really fast. Many of them have been around for 20 years, so they have a strong operating history, and they just, for whatever reason, aren't able to access based on their size or the risk profile. the more traditional channels of financing their business. So I think, let's see, I'm going to wrap up, and I will see if there are any questions with this slide, just to sort of summarize. These tend to be floating rate instruments, which is good if you expect rising interest rates and inflation. There's a illiquidity premium and a yield premium, particularly contingent on good underwriting. Historically, there have been good recovery rates in direct lending to the mid-market. You can really customize the loan document to protect yourself because they tend to be bespoke or customized documentation versus being really cookie cutter. However, for investors, it's not the easiest thing, which is one of the reasons I think the opportunity at least continues to exist for now. It's complex, it's illiquid. It's difficult to differentiate, if you haven't done this, between the different managers and where they might be taking risk and how much leverage they may have at their fund level, how much risk they're taking versus the companies, how good they are at underwriting, and whether they have operating capabilities. All those things are very important. But ultimately, I think if you have the ability to allocate to this area, this is again one of the areas across capital markets where we see a tremendous amount of responsibility at this point in the cycle. So with that, I'll wrap it up. And
Andy, I had a couple of questions.
Go ahead.
Sure, and I put them on chat as well, but maybe you can talk a little bit about like the duration that you prefer when it comes to lending. Like, I mean, it seems to be a lot of short duration products, other products that are, lending, and also maybe you can talk about, the impact of. I think the rates have gone down for junk. Let's call it junk bonds, et cetera. So the spread between investing in junk and other credit products which are let's say about the same risk or less risky has really increased, right? Maybe you can talk about that a little bit. And also, maybe you can do like a talk about lending platforms, VC lending, cannabis, and also I want to know if merchant cash advance is dead. So
okay, let me take those one at a time. In terms of duration, this is an excellent point. And historically, direct lending was a low duration asset class where you might be underwriting to like a 12 or 13 or 14% cash coupon, but then because you were lending into a company at a time of dislocation, they would pay you back in a year, and your return multiple would be 1.2, 1.3, 1.4, which for us as a long-term investor, for many endowments and for many family offices, is not that compelling. We prefer to, if we can get a long duration, somebody who's going to compound the capital over many, many years, then that's much more preferable. I will say that in the implementations we're seeing now, there's some pretty attractive terms. The instruments tend to be 3 to 4 years. And the really interesting thing is if you're lending, say, at 15%, and you're getting 3 points of discount on the going in, and then maybe an exit fee or warrants on the way out of, say, 3 to 5 points, that underwrites to a high teens return. And we are seeing at least one manager who is able to secure a 2-year make whole, where they've essentially locked in 2 years of interest, even if they get paid back tomorrow. So that makes it, a 1.3 minimum type multiple, which is very interesting. The other way to increase, there are 2 other ways to increase the duration or the multiple associated with a given rate or IRR. One being to leverage it up, which again, not huge fans of, but the other is to recycle. So to the extent the manager gets paid back early, they're able to do another transaction within that fund, and then recycle and compound for a second go. And that has some really favorable aspects in terms of fee. So if you're paying an incentive fee, which most of these strategies have, it comes out of this when the capital comes out after the second term. And so it's actually good for the sponsor, but it's also good for the investor because that carries at risk during that period. Spreads, you mentioned high yield spreads are historically tight right now. So high yield, we think of as a periodic opportunity. It's absolutely can be very compelling. It's liquid. You can get in and out very well. It's relatively liquid. I mean, anything can become illiquid, but compared to these structures, it's more liquid. And to the extent you can time when spreads widen out, it can be a very compelling thing. But right now, spreads are very tight, and so these types of returns we're talking about in direct lending, the illiquidity premium is quite attractive. I think we may be out of time. Maybe we'll have time for one more.
You have time for one more. I mean, you were going to talk about cannabis,
right? So cannabis
and VC lending,
right? VC lending. Certainly there are niche banks and providers to that. I think for us, we certainly prefer underlying companies or managers who are lending to companies who are at least generating cash flow or breaking even to being a growth business. I think more of a late stage or a growth equity type of a strategy. VC lending is interesting, again, at a time in the cycle. I think now, for us at least, it's probably not our first choice. Okay, well, thank you.
And I'm sorry, Andy, what about cannabis? Did you discuss it already?
I didn't discuss cannabis. So cannabis is really interesting. There's some really interesting dynamics in that market with deregulation that we're seeing coming. I actually prefer to invest in that from an equity perspective. Not that we haven't actually done anything. We've seen and looked at some strategies. I think it's not for institutional clients. I think are a bit wary of it at this point in time. But it's there's some really interesting things with dynamics between regulations on people operating in multiple states, and then if that were to unwind, creates a really great opportunity for the large operators who are ready to, who already have an advantage in terms of, their capital footprint, their operating footprint, their marketing, their brand, to really, as soon as that so that regulation unwinds, if it does, I think there are big players who can create a lot of value. But I think most of the U.S. companies have to list in Canada and vice versa currently, but there could be some interesting opportunities in the multi-state operators.